The questions I get a lot is, how do I know if I'm going to sell above an old high? How do I know it's not going to keep going higher? Well, that's the underlying market structure and the trust in the factors that I'm going to kind of like teach you tonight. This is an aggressive entry for going short. Now, that hourly chart was showing those two candles going up. In the 15-minute time frame, it's obviously more candles. So in this up close candle series of 1, 2, 3, 4, 5 candles, in that range, if I get a fair value gap form with a breakdown like this, notice I don't need a swing low broken. Notice that? You have to look for what? The short-term low being broken. That's your market structure shift. Then you see price go up into that imbalance, and then you can go short, or vice versa when you're going bullish. If you understand market structure with this perception, looking at it from a higher time frame and anticipating a breakdown, but then starting to classify each imbalance and swing high and swing low, intermediate term highs and lows are formed at the rebalancing of an imbalance. If the intermediate term high is not higher than two short-term highs, that is telling you that the market is very weak, and the algorithm is tipping its hand to those people that are looking at it like this. Who would be looking at it like this? Smart money traders. They're looking at imbalance, rebalance, and liquidity. That is it. This is your aggressive entry. You don't need a swing low being broken because you have the idea based on market structure suggesting that this is exceedingly weak. If it's exceedingly weak, that means the next short-term high, how do I know it's going to be a short-term high? I don't know because I'm studying the up-close candles because that's going to be an order block later on. Now, everybody else knows how to look at these candles after it goes below it and comes back up and bumps the bottom of that right there. So the bottom of that rectangle, that's the classic ICT bearish order block. The advanced interpretation of an order block would be using market structure like this, which is unconventional, but you start seeing the imbalances inside the order block when you're already expecting it to sell off. See, this intermediate term high, I already know that this rebalance here classifies this in my mind as an intermediate term high. That means it should not trade above that high. Just like this short-term high and this short-term high did not trade above this intermediate term high. Why is this an intermediate term high when it didn't even rebalance anything? Here's a long-term high. Here's a swing high over here and a swing high over here. See that? Long-term high, right? Intermediate term high, short-term high, short-term high, or if you want to use this one, I'm using this one, not classifying this one because this is energetic. It moves lower. You could have easily had a short-term high marker there, but I'm using this one because it has that run lower to rebalance. The intermediate term high has a lower short-term high to the left of it and a lower short-term high to the right of it. So intermediate term highs, there's two classifications. It is a short-term high that has a lower short-term high to the left of it and a lower short-term high to the right of it. Or, and this is the main one here, it trades back up to rebalance and imbalance. That immediately becomes an intermediate term high. Now, the usefulness of that is if we're bearish and it rebalances like this, the next short-term high should be lower than that intermediate term high. If it trades higher than that, then your trade idea is probably flawed. Don't force that trade. Again, wait for market structure to get back in sync with what you're expecting, something bearish. That's how you keep from blowing your account or forcing your will in the marketplace. Inside these candles as it's going up, I'm looking at lower time frame charts, and this is a 15-minute time frame. We see it break down. It doesn't take any short-term low out, but it's inside these up-close candles, which is an hourly order block of 2 candles each. Your stock could be right above that high. Classic low-risk, high confirmation short entry is the classic return back to an order block after it trade down below it. Here's your little gap. Trade into it. There's your short. Where's your stop? Above this candle's high. You can go down into the charts deeper with your 5, 4, 3, 2, and 1 narrowing down to a smallest time frame. You can see that the last 2 candles here, wait for the turn, inside the order block. These last 2 candles here with the gap, that low is exactly to the quarter point as that candle's high right there. Why am I pointing to that candle? Because the order block is one consecutive series of up-close candles. It's not the last candle before the down move. Order block theory is much more than just simply the last up-close candle before the down move or the last down-close candle before the up move. That's not it. This is it. You have the up-close candles together here with the imbalance inside of a larger order block within a bearish market structure because we have an intermediate term high here. Then this run up is going to fail to go back above this high. The imbalance here, it goes over a little bit. That's okay. But inside this range in here, more specifically, the order block, the hourly right here, that's where your fill would be, or aiming with your limit order. And the heat on the trade would be on this candle's movement there, but your stop will be above here. What I want you to think about is when you see these patterns for entry, the idea is this. When you see an imbalance get rebalanced, the high formed as it rebalances, that high should not be violated by price going higher than that if you're bearish. If you blend that with institutional order flow, what is institutional order flow? When you're bearish, all of your up close candles should keep price from going higher than them. What does that mean? We have an imbalance here. The market trades up into the bullish candles that are on the 5-minute chart. We're on a 4-minute chart. That's that red level here. Let me go back up just so you know. That's this one here. This is a down close candle right there. These are the last two up close candles before the displacement here and imbalance. The market trades back up into that right there. There's your bearish order block. It's aggressive, but if you know you're looking for, that's very, very fun to do that. On the 4-minute chart, there's that same return back to that 5-minute bearish order block. Watch what happens. Market breaks lower, so we have up close candle and up close candles. The market trades higher, yes, but does it overtake this up close candle? No, it just trades back up into it a little bit, but doesn't go above it. That's important, because if it doesn't overtake these up close candles here or here, it doesn't even need to get to these because it hasn't even overcome this one. So it acts as real resistance. That's institutional order flow. Your market, when it breaks again from the consolidation in here, all of these up close candles never get reached into again here at all. But notice what we've got over here. We have up close candles. The market leaves it. Then it comes right back up. Does it overtake these up close candles? No. So it's going to remain heavy. So in short, I've taught you tonight to look at the markets from a market structure perspective by breaking down the price swings, labeling them, specifically an imbalance that's rebalanced. That intermediate term high or low should not be violated. That's a key high or a key low. That sets the stage for a market move that should unfold and deliver to a higher time frame objective. If you combine that logic with market structure and the imbalance rebalance becomes intermediate term highs and lows, those key highs and lows, with them not being violated, if they are violated, that means your idea is wrong. And you cancel the idea and you don't try to go in and force it again and overtrade and blow your account. While the market is moving in your favor, you're going to continue to trust that move and hold on to your trade, because if you're bearish, up close candles should keep price below it, or them if it's multiple up close candles. They're speed bumps. They may come back up and touch them and act as a what? Bearish order block. But you do not want to see them traded above if you're bearish. And vice versa. If you're bullish, predominantly there's going to be more up close candles when it's bullish. But down close candles should support price. If it trades back down to them, it's going to act as a support structure for an order block. If that intermediate term high or low is broken after your trade idea becomes possible, if that intermediate term high is broken and you're bearish, then you got to move to the sidelines and don't go in again. Wait for more setups in the future. It may be in the same trading session, or it may be in the same trading day, or it may require you to trade in the following week. You just can't force it. I taught you institutional order flow, which is, again, we're bullish and we're expecting a price swing higher. Generally, there is not a lot of down close candles in that price swing higher, but those down close candles should support price should it trade back down into them and not see them overlapped, in other words, going down below it. If it does, it's only permissible if there's a short-term low in close proximity to it, and it's then likely to just go down and take out some sell stops if it's bullish and then reaccumulate and go higher. If there is no swing low, there would be no swing low with sell side below it, so there's nothing to concern yourself with. Just look for down close candles to support price higher. So in other words, price swings that are bullish, down close candles are your support. In price swings that are bearish, up close candles are your resistance.